In this video, we'll discuss the top 12 things investors must know before buying stocks. Investing in the stock market can be a great way to grow your wealth over time, but it's important to have a solid understanding of the fundamentals. So let's get into it. What is a stock? A stock represents ownership in a company. When you buy a stock, you become a shareholder of the company, which means you have a stake in the company's future profits and growth. For example, if you buy Apple stock, you own a small piece of Apple and you will share in the company's profits and losses. As a shareholder, you have a say in how the company is run through voting rights at shareholder meetings. Stocks are usually identified by their stock ticker, a unique symbol used to represent a specific company on a stock exchange. Here are some examples of popular stock ticker symbols. Investors and traders can use these symbols to look up information about that particular company's stock, such as its current price, historical performance, and other relevant data. It's also important to understand why companies issue stock. Companies issue stock to raise money for their growth and expansion. By issuing stock, companies can raise capital without incurring debt. This is important because debt comes with interest payments that must be made regardless of the company's financial performance. For example, if a company issues $100 million in bonds with a 5% interest rate, it must pay $5 million in interest every year, regardless of whether the company is profitable or not. On the other hand, if a company issues $100 million in stock, it doesn't have to pay any interest and it can use the money to fund its growth and expansion. How do people make money with stocks? People make money through stocks with capital gains, appreciation, and dividends. Capital gains appreciation is the increase in the value of a stock over time. For example, if you buy a stock for $50 and it increases in value to $100, you have made a capital gain of $50. Dividends are payments made by companies to shareholders as a reward for owning their stock. For example, if a company pays a dividend of $1 per share and you own 100 shares, you receive a dividend payment of $100. Stock exchanges and brokerages are both important entities in the world of investing, but they play different roles in the process of buying and selling stock. A stock exchange is a marketplace where stocks, bonds, and other securities are traded. Examples of well-known stock exchanges include the New York Stock Exchange, NASDAQ, and Tokyo Stock Exchange. The role of the stock exchange is to provide a centralized location where buyers and sellers can come together to trade securities. The exchange sets the rules for trading. It also provides transparency and accountability to the market by ensuring that all trades are executed fairly and efficiently. On the other hand, a brokerage is a financial institution that acts as an intermediary between buyers and sellers in the stock market. Brokerages provide a platform for investors to buy and sell securities on the stock exchange. Something a lot of people don't understand is when you buy or sell a stock on a stock exchange, you are buying or selling it from another investor, not from the company itself. Some popular brokerages you've probably heard of are Vanguard, E-Trade, Charles Schwab, Robinhood, Webull, and TD Ameritrade. Stock prices are determined by supply and demand on the stock exchange. When there are more buyers than sellers, the price of the stock will go up, and when there are more sellers than buyers, the price of the stock will go down. One key factor that drives the demand for a stock is the company's financial performance. When a company performs well and generates higher profits, investors may become more interested in buying the stock, which can drive up the price. Conversely, poor financial performance can lead investors to sell their shares, causing the price to drop. Another factor that affects the price of a stock is market sentiment. This refers to the overall feeling or perception of investors toward a particular stock or the stock market as a whole. The supply of a stock is also an important factor that affects its price. When a company issues new shares of stock, it increases the supply of that stock on the market, which can cause the price to drop. Conversely, when a company buys back shares or when demand for the stock is high, the supply decreases, which can drive up the price. The majority of stock market trading is done by computers. While most people think of stock market traders as people yelling on the trading floor, the reality is that the majority of stock trading is done by computers. High-frequency trading algorithms, which use advanced mathematical models to make split-second trading decisions, now account for more than half of all stock trading volume. The stock market is volatile, which means that stock prices can fluctuate rapidly and unpredictably. It is important to be prepared for market volatility and to not panic when stock prices drop. Market volatility can be caused by a variety of factors, including economic conditions, geopolitical events, and company-specific news. While market volatility can be unsettling, it's important to remember that the stock market has historically provided solid long-term returns despite short-term fluctuations. What is the difference between mutual funds, index funds, ETFs, and individual stocks? A mutual fund is a pool of money from multiple investors that is invested in a diversified portfolio of stocks, bonds, and other securities. Mutual funds are managed by a professional fund manager who makes investment decisions on behalf of the investors. Some advantages of mutual funds are they provide diversification, which helps reduce risks, and they are managed by a professional fund manager, which can be beneficial for novice investors. Mutual funds are easy to buy and sell, and they offer access to a wide range of investments. The disadvantage of mutual funds are the fees they charge, including management fees and other expenses, which can reduce returns. Mutual funds are subject to market risk, and their performance can be influenced by the fund manager's decisions. An index fund tracks a specific stock market index, such as the S&P 500 or the Dow Jones Industrial Average. Index funds aim to replicate the performance of the index they track, and they are passively managed, meaning they do not require active investment decisions from a fund manager. The advantages of index funds are they provide low-cost exposure to a specific market segment, and they typically outperform actively managed funds over the long term. They are highly transparent as their performance is closely tied to the underlying index they track. The disadvantages of index funds is they are subject to market risk, and their returns can fluctuate with the performance of the underlying index, and they offer less diversification than other mutual funds as they are focused on a specific market segment. An ETF, or exchange traded fund, is a type of investment fund that is traded on a stock exchange like a stock. ETFs are similar to mutual funds in that they pool money from multiple investors and invest in a diversified portfolio of stocks, bonds, or other securities. However, ETFs are traded throughout the day like stocks. The advantages to ETFs are they provide diversification and access to a wide range of investments with lower fees than many mutual funds. They also offer the flexibility of trading throughout the day and can be bought and sold like individual stocks. The disadvantages to ETFs is they are subject to market risk, and their returns can fluctuate with the performance of the underlying securities, and they may have higher trading costs than index funds and some mutual funds. An individual stock represents ownership in a single company. The advantage to buying individual stocks is you have the potential for high returns, as successful companies can experience significant growth over time. Investors can choose which stocks to invest in based on their individual preference and beliefs. The disadvantages of buying individual stocks is you can be subject to significant risk, as the value of a stock can fluctuate rapidly based on company performance or external factors. It can be difficult to pick winning stocks, and individual stock portfolios can lack diversification. Investors must also conduct significant research and analysis before investing in individual stocks. Diversification and asset allocation are two distinct concepts in investment portfolio management, although they are closely related. Diversification in stock market investing means spreading your investment across multiple stocks or other types of securities to reduce risk. The basic idea is that if you have all of your money invested in one stock or one sector, you're taking on a lot of risk because the performance of that stock or sector can be highly unpredictable. Diversification can help you mitigate this risk by allowing you to spread your investment across multiple stocks or other types of securities. For example, you might invest in stocks from different sectors such as technology, healthcare, and energy. You might also invest in different types of securities such as bonds, mutual funds, or ETFs. Asset allocation, on the other hand, refers to the process of dividing an investment portfolio among different asset classes such as stocks, bonds, cash, gold, and real estate, and these are based on an investor's goals, risk tolerance, and investment horizon. Both diversification and asset allocation are important strategies for managing risk and optimizing returns in an investment portfolio. As you get more comfortable with stock market investing, you'll hear a lot about the S&P 500, which is a stock market index that includes 500 of the largest publicly traded companies in the United States. These companies are selected based on their market capitalization, industry, and other factors. The S&P 500 is often used as a benchmark to measure the performance of the overall stock market because it includes a broad cross-section of companies from various industries and sectors. This is why many investors and analysts use the S&P 500 as a barometer for the health of the stock market and the economy as a whole. Additionally, it's important to have a long-term perspective when investing in the stock market, as short-term fluctuations can be unpredictable. It's important to keep a long-term perspective and not panic when stock prices drop. Historically, the stock market has provided solid returns over the long term, and investing in the stock market can be an effective way to build wealth over time. To be a successful stock market investor, it's important to do your own research and stay educated about the companies you invest in, the industries they operate in, and the broader economic conditions that may impact your investments. Additionally, it's important to have basic understanding of financial statements and metrics such as earnings per share, price-to-earnings ratio, and return on equity. To sum it up, stock market investing can be a great way to build your wealth over time, but it is important to have a solid understanding of the fundamentals before you start investing. I really appreciate you watching. If you haven't subscribed already, please consider doing so, as the majority of people who watch this channel are not subscribed. If you're not sure what to watch next, check out this video right here that YouTube thinks you will really enjoy. Take care, and I will see you next time.